everyone. Today I'm doing a video called Mining Stock Trading Plan number 3, and this one is called Don't Panic. And in my opinion, well, let me scroll down, and I've written some words here so that I don't have to go searching as much as I improvise my way through this. This is like my third take, and the other two I just felt were too long. But anyway, there are 2 ways to avoid panic. Panic is, in my opinion, the most important thing to avoid if one wants to be successful in trading or investing. And once you get beyond panic, then there's obviously other things to learn too. But one type of an undesirable panic-caused reaction is impatience. And I've certainly had that. And so I've got the 2 ways listed right here. And this first one is already completed. So if you have a plan and you're not, then you're less likely to panic because you have something you can follow. And I already have a plan, and I'm not saying this is your plan, and I'm not even suggesting you adopt my plan. I'm just sharing it with you, and you know, if you get something out of it, that's great. This isn't advice. But if I state this plan as simply as I can, it is to buy, and that's mining stocks or gold in August of 1999 and sell in August of 2011. Now, I know that's in the past, but let's work our way to the future. And the plan is to buy again in September 2018. And I say, well, if I hadn't bought in by then, and I was just looking at today's date, which, like I said before, today's actual date is February 16th, but the last market day that has been completed was Friday, February 12th. So I'll just throw that in there. And then sell when the Dow Gold ratio equals 1 or lower. And I estimated, you have to go look at those 13 videos. I've estimated the future date as March 2024 when that'll occur. But the real thing is dateless. It's just the Dow Gold ratio is when it hits 1 or lower. And I believe it's going to hit 0.62. So that's already done. And briefly, before I get into what this video is about, I will go back and look at that. Let's see. And that is, I believe, it's on this page. So if I zoom out a little bit, I can discuss that, where that's coming from. And so this is the pattern. And if I want to draw on it, the thing about having a pattern like this is that it is rather long-term, but long-term patterns are reliable. And it only became predictable after this. In other words, and I've already got it drawn here, this point and this point takes 2 points or 2 patterns to predict a third point. So that's in all those other videos. But what this is telling me is that I buy in August 1999 and I sell in August 2011, and by that I mean sell mining stocks. And then in this time period, I buy just regular stocks. And then this time period turn, I got the signal September 2018 to switch from traditional type stocks like the Dow and into mining gold and mining stocks. And just briefly, I will say, because I haven't talked about this before, I threw in some calcs over here. And because in a future video, I do want to talk about what's different about a particular point, which is this point right here, 310 2008. And what is different about that time period was when the financial crisis occurred. And here is that the Dow Gold ratio has only gotten started moving down. It's 24% into its move down. And here it was 77% complete. So I'll go into that more later, because on mining stock trading plan number 4, I'm going to talk about adding some complexities to this plan. Right, this video is, again, it's about not panicking, and the methodology I'm using to not panic is to look at the past. And let's go ahead and get up to speed on that, because I've written some words about it, and it'll save me time if I just read through it. Let's see, where am I? I'm on, oh, it's down here, it's on this one, okay. And let's see, I make this a little bigger so you can read it and take a screenshot if you wanted to. Okay, well, this video is, I'm back testing. So I'm looking at that time period, especially August 1999 through 2011, because that's the only completed time period in which we've gone through a whole entire mining cycle or gold cycle, depending on your preference. And so I want to back test and use my imagination to live through that mining and gold bull phase and see what I would have had to go through. And the idea is, when you're zoomed out and looking at the big picture, you don't see what you got to live through, and what you got to live through is those pullbacks. And I'll continue finishing reading, otherwise I will just get off track. All the while trying to tell my younger self, and I say, which we are all aware still resides within us, no matter what our chronological age is. I could delete that. It seems like I'm trying to get a little preachy wisdom on it if I do another take. All the while trying to tell my younger self, I'll correct this echo because I might not put this one out. Talk my younger self into having a little bit of patience. So panic, bad; patience, good. Okay, we've got that. Now let's go live through what we would have had to have lived through in this time period right here. And I can tell you, I did this and it saved me. So there, from this time period to here, where I've got this thing, including that little point of contention. We've got to live through that too, and it's not good. That point right there is not a very pretty point, as you will see. So I think now I go, well, here it is visually. Let's see if I can get back to one of these. Here's that point visually, and I know it well. 3/10, March 10th, 2008, start of the financial crisis, and you can see what mining thought of the financial crisis. And if I have gold down here, well, I don't have it, but gold shrugged that off a lot easier than the miners did. The miners move in multiples of what gold does, both up and down. So it's a double-edged sword. Anyway, let's get to, let's not get ahead of ourselves. Let's talk about some of the key points right here. So this segment started in end of August of 1999, and let's just visually look at those segments, which I've kind of arbitrarily chosen. Some of them, like for example, this D segment, there's up and downs in it, but I don't catch every little up and down. I'm just looking at some big moves. Okay, but at first I do look at some small moves because those are psychologically important. So you can see right off the bat, and I do have the live chart here. It might show it better on the live chart. We're looking at point A. We're going to spend a little time on point A. There's the gold chart. I've got these. I've got the Huey and the gold live charts here. And so if we look at where my signal from the Dow Gold ratio told me to get in, it told me to get in at the end of August, if I could find it. Come on. It's getting close. There. Well, some reason I'm having, there it is. It's at 68, and you can see that the first thing I did right after I got in there is I went up, and that was a ego boost, whatever you want to call it. So let's live through that. What would have happened, you know? And so we got off to a good start, and I'm assuming we started with 100,000. I just arbitrarily chose that number. Just so I'd have a number to look at. But let's say started with 100,000, and for 35 days I was in mining stocks. And mining, I used the Huey to represent the individual mining stocks I was in, but actually my mining selections are actually doing about double what the Huey does. I mean, for now they are anyway. So during those first 35 days, up 34%. Wow. I imagine myself in a cubicle working for an engineering firm. You imagine whatever it was you were doing at that time, and I know exactly what I would have done. I would have been obsessively checking that number almost every day. In 35 absolute days, there's approximately 24 work days or market days. Those are usually the same thing. And so I would have calculated, hey, how much am I making per day on this? I mean, I would have been a little over a month in absolute and likely been bragging about this, which is a terrible idea, because once you bring other people into this, then you're going to overreact, as you're going to see when. Anyway, that's kind of separate advice. That's real personal, but anyway, I probably would have done this and bragged about it, just to be honest, because I was that immature. And then, then we enter this phase here, which the next phase, which lasts more than a year, and I'm down 60%. Well, I can tell you what I would have done. At some point, I would have got out with a loss, most likely. But this is just imagination. This didn't happen. I actually got in here, and I'm jumping ahead a little bit, but I got in right here. At this point, what happened to my? Let's see. If I hit home again, will I get my? There we go. I actually got in right there, and it dropped. And I can tell you, that's nothing like the 60% here. But having been through this thought experiment of going from 100,000 down to 52, and dropping by almost half of what I started with, that would have been brutal, because even this was brutal. Uh, and you know what? That's not that real number right there. I just typed that in. These are not my numbers. These are just the numbers that fall out from starting out with 100,000 at this point right here. So you can see the 100,000 dropped to 52, and I will say that that would have been the worst point right there, is when you go less than what you started with. Okay, and another point, and this is, gosh, we're getting into 3 years in right now. It would have kept rising. Up to this point would have been a point of contention, because by that point, after 3 years, I might have been saying, oh, heck, let's just get out of this. Let's just get out of this. This is not what everybody, I'm doing something that's different than what everybody else has done, and I've bragged about it. And, now if people ask me about it, I can either be dishonest and tell them I'm doing a lot better than I was. It's just best not to say anything. And you say, well, why are you talking about this on a video? I don't talk about this with people I know. Okay, so, and I can assure you, one of the places, you get the number of views that I get, which is very little, it's almost like this is the best place to put something if you want to keep it a secret. And, that's kind of funny, but it, in a way, it's not. But anyway, that would have been a big point right there, because I'm back a little bit above and I'm exhausted thinking about this, probably checking it every day, worrying about it, and it's a form of panic. But I can say that, having been through this thought experiment right here, I was able to get through it. And there were 2 times, and while this is not the amount, I'm not trying to suggest that's the amount of money I had in this situation, but these, from here down, these down to here, that's the present day right there. Those are very similar to my percentage experiences. I've experienced all of those. And that's why I went ahead and typed in, I typed in an even number, 2 million, and it'll just continue calculating here. Well, there's 200,000. That wouldn't be a bad number to use, and it'll just recalculate the numbers. But I'll just go ahead and leave the. Because it doesn't matter. We just started with 50,000. All right. So this time around, unlike this time, it dropped right off the bat. So right after I've come up with my big theory, and thank God I didn't tell anybody about it, I dropped 8%. And that was bad enough, but if I'd told somebody about it, I don't know. Then you start bringing complexity into something that's pretty simple. I decided my plan was good enough, and of course, I was over elated here. Uh, Up is better than down, but and also when it drops, if you really believe in your plan, that's when you buy more. And I think I was certainly buying more. So I was committed to the plan. And as a result of going through this mental experiment, I was prepared. Oh boy, I hoped it didn't happen, but I was prepared in order to find the bottom, to just keep investing on the way down. So that was a big point of a possible problem. And then yeah, it went up, and then here I'm showing it dropping down to slightly less than where I got in at. So where I got in at is obviously that number. So anytime you're below the number you got in at, I've found that is something that's bothersome psychologically. And then after that, it's never, and I hope it doesn't ever do that again. But we're in a time period right now where I'm expecting, uh, here's the present day, and so I've extrapolated into the future a little bit of what I look on the graph as, it's already dropped from its top here at 4 million, 4.6 million, and but the thing is that this number is bigger than where I got started. So I'm not that, I've got a cushion, in other words. So these two are the problems right here. And as you can see, I actually did this exercise, maybe not in this exact form, but I went through this and I saw how bad it could be in mining stocks. And that's what allowed me to get through these two drops right there. Is the main point of the video. Let's look at it. Let's look at it again. Now, in the great thing about this, and what makes these videos long, is I get excited when I come up with an idea for not avoiding this drop completely, but avoiding maybe 2/3 of it. And so I'm looking for an exit plan, actually. If you haven't got in yet, you're obviously looking to enter. And the first two videos talk about, when you get in and it drops, if you believe in your methodology, you would continue buying. And if you don't believe in your methodology, you should go back to square one and rethink it. So that would be my advice. And that's really all I've got on this video. The main point is look at the past, and that is what you would have had to live through, but look at the reward as well. I mean, I'm coming up even with this big negative right here. That's the deflationary crisis move, and I'm getting into the next video's territory right now. How can we avoid that drop right there? Because if we avoid that drop, this number gets a lot bigger. I mean, let's just say, instead of going from 750 all the way back, I would add to exactly that same number. That literally happened. If you separate it went up to there and went down to there. Well, my idea in a future video is to roll into gold when this thing, let's see if I've got it down here. Use the Dow gold ratio, not the Dow gold ratio, the Huey to gold ratio. And I'll get into that in another video because I don't want to make this too long. But let's just go ahead and just, for a teaser here, let's plug in. Let's see. So that drop, do I have the drop here? Is instead of dropping from 750 down to 248. Now I want you to keep your eye on that number right there, which is 13 million basically. Okay, so if we avoid that, which we certainly would like to, but we don't avoid it completely, and let's say we drop down to 450,000, what do we end up with? 23 million. almost double. So yeah, it would be worth the psychological benefit of not having to go through that. It is amazing. Would be amazing. I mean, that would be tough to go through, to watch, even though you're still up. You would have to buy on the way down if you had more money. But we're just starting with 100,000 on this video. Okay, so that'll be a future video, and I think that's all I've got for this one. Let's just go check and see if I did what I thought I did. There is, going back to here. And back test, and we're using our imagination to live through what that original bull phase would be, and if we do that, then we make these pullbacks that are inevitably going to happen a lot easier. And I will say this, just to wrap up, uh, who you're competing against is other people buying mining stocks, and there's almost no competition as of yet, because most people we've been in a 40-year, 41, 42-year bond market, and people's idea of investing is to invest in bonds and get 5% and never have to deal with a pullback. Well, if you can somehow figure out a way to increase your tolerance to pullbacks, then you are literally in a market that has almost no competition. All right, I'll finish up there. If you're trading, good luck trading, and if you're investing, good luck investing. Thanks for watching.